trading gold can be incredibly rewarding when you have the right strategies. In this video, I'm going to share 4 highly profitable gold trading strategies that can be used for scalping, day trading, and swing trading. These aren't just theories, they're practical setups designed to help you take advantage of gold's volatility. By the end of this video, you'll have a clear roadmap to trade gold more effectively and confidently. Let's begin with the first strategy, the stop hunt trading strategy. Before we dive in, let's clarify what a stop hunt is. Look at this chart. You've identified a clear support level where the price has bounced off multiple times, making it a key area that catches everyone's attention. Now, look at what happened next. The price approaches that level again. You expect to bounce and place your trade. But instead of bouncing, the market pushes just enough to hit your stop loss, only to reverse right after. Institutions do this on purpose to hunt stop loss orders, gather liquidity, and drive the market in their intended direction. The key to leveraging this strategy is to think like the institutions. Start by identifying an obvious key level, a support or resistance level that stands out on the chart. Why obvious? Because the more traders focus on a level, the more stop loss orders accumulate around it, making it a prime target for a stop hunt. For instance, look at this chart. The price touched a resistance level several times, making it an attractive area for retail traders to place their stop losses just above it. Patience is key. Wait for the price to break through the obvious level and then close below it. This fake breakout is the stop hunt. It lures traders into thinking the market is reversing, but in reality, it's a trap. Here's where your edge comes in. Instead of reacting emotionally, you zoom out to see the bigger picture. Switch to a higher time frame. In this example, we're working on the 5-minute chart, so the higher time frame is the hourly chart. This step is crucial. Institutions often align their moves with the overall trend visible on higher time frames. For example, if the hourly chart shows a downtrend, the stop hunt at resistance is likely a setup for the market to continue downward. This alignment gives you confidence to follow the institutions rather than fight them. As you can see, on the hourly chart, the market is clearly trending down, so institutions are selling and are willing to drive the market downward. Let's return to the 5-minute time frame. This stop hunt is only a trap to take retail traders' money and then continue in the downtrend. Now, how do you trade this setup? You place your entry at the close of the candle that created the stop hunt, set a stop loss above the candle wick, and target the next level. Before taking the trade, always make sure the trade offers a 2-to-1 reward to risk ratio. Let's look at another example, this time at a support level. Here's the setup. The price has bounced off a strong support level multiple times, making it a clear buying zone for retail traders. Naturally, stop losses are placed just below this level to protect their positions. Now, here comes the trap. Institutions push the price just below the support level, triggering those stop losses and grabbing liquidity. The market then quickly closes back above the level. That's your confirmation. The stop hunt is done, and the institutions are ready to drive the price higher. Let's check if the trade setup on the lower time frame aligns with the higher time frame by looking at the hourly chart. As you can see on the hourly chart, the market is trending upwards. Here, the market broke a resistance level, which then became support. The price pulled back to retest this level and got rejected, indicating that the market is likely to make another move upwards. This confirms that the higher time frame aligns with our trade setup signal on the lower time frame. Now, let's return to the 5-minute chart. Here's how you trade it. Place your buy entry at the close of the candle that created the false breakout at the support level. Set your stop loss just below the support level. Target the next resistance level, ensuring at least a 2-to-1 reward to risk ratio. What if I told you there's a way to catch market reversals before they happen, using a simple but powerful tool? This is where divergence trading with the relative strength index indicator comes in. And to make it even better, I'll show you how to supercharge this strategy by combining it with smart money concepts. Let's dive in. Divergence is like the market revealing its secrets when price moves in one direction, but your RSI indicator tells a completely different story. This contradiction is often the first clue that a reversal might be on the way. There are 2 types of divergence. Bullish divergence. The price makes lower lows, but the RSI makes higher lows. This signals that the downtrend is losing strength, and an upward reversal could be near. Pro tip: When connecting the lower lows, always use the bodies of the candles, not the wicks. The second type is the bearish divergence. The price makes higher highs, but the RSI makes lower highs. This indicates that the uptrend is losing momentum, and a downward reversal is likely. The beauty of divergence lies in the RSI's ability to expose hidden momentum shifts that price action alone might not reveal. Let me show you how to trade this strategy. As you can see, the market is making a lower low on the price chart, while the RSI indicator is showing a higher low. This is a clear bullish divergence, signaling that the downtrend is losing momentum and the market is likely to move upward. Now, let's switch to the hourly time frame. Here, the market is clearly trending upward. As you can see, the market is making impulsive moves followed by retracements, which are pullbacks. According to market structure, this pullback is likely to be followed by another impulsive move. This confirms the signal from our 5-minute time frame divergence and gives us the confidence to take this setup seriously. Now let's return to the 5 minutes chart. You can place your buy entry at the close of the engulfing bar. Set your stop loss few pips below the engulfing bar. Finally, aim for the next resistance level, ensuring at least a 2-to-1 reward to risk ratio. Now, what if we could make this strategy even more powerful? By combining divergence with smart money concepts, you can take your trading to the next level. Here's the enhanced approach. Combine divergence with key levels. Look for divergence near clear support or resistance levels. These levels act as magnets for price and increase the likelihood of a strong reaction. Then, look for a liquidity sweep. Before the market reverses, institutions often create a fake breakout, pushing the price just beyond a key level to trigger stop losses. This move gathers liquidity for the next big move. Let's break it down with a real example. The price approaches a clear resistance level, breaks above it, and then quickly closes back below. This is a classic liquidity sweep, where smart money traps retail traders and grabs their stop losses. Now check the RSI, it shows bearish divergence. While the price made a higher high, the RSI made a lower high. This confirms a divergence between the price and the RSI indicator. Now we have two important factors to consider for a selling trade opportunity. We have an obvious resistance level, and a liquidity sweep that occurred to trap retail traders, which is a sell signal. We also have RSI divergence, which serves as another sell signal. Now switch to the hourly chart. As you can see, the higher time frame is showing a range, and the market was rejected from this supply zone. This suggests that the market may continue to move downward slightly, providing an opportunity to profit on the 5-minute time frame. So, let's return to the 5-minute chart to take this trade. Here's how to trade it. Place your entry at the close of the candle that closed below the resistance level. Set your stop loss just above the wick of the candle. Aim for the next support level, ensuring at least a 2-to-1 reward to risk ratio. Let's dive into the last strategy, trend line trading. Trend lines are key levels formed in trending markets, and they're invaluable for spotting high probability trading opportunities. Why? Because when the price interacts with these levels, it often creates setups with a high win rate. When trading with trend lines, there are two primary patterns to watch for. Continuation pattern. This occurs when the price touches the trend line and bounces back in the direction of the trend, signaling a continuation. Breakout pattern. This happens when the price breaks through the trend line, indicating a potential reversal or shift in the trend's direction. One of the most common challenges for traders is figuring out how to draw trend lines accurately. Should you connect the wicks, the candle closes, or the candle bodies? The answer: draw them in a way that captures the most touches possible. Let me walk you through it. On this chart, we spot an uptrend where the price is making higher highs and higher lows. To draw the trend line, place it below the trend to connect as many touch points as possible. And then, adjust the line to align with the price action while keeping it as clean as possible. Notice that some candles might overlap the trend line, while others may not touch it at all. That's completely fine. Treat the trend line as a general zone, similar to support and resistance. Okay, here, the market is in a downtrend, forming lower highs and lower lows. To draw the trend line, place it above the trend and adjust it to get the maximum number of touches. Remember, the goal is to make the trend line practical and effective, not perfect. Now that you know how to draw trend lines, Let's use them to find reliable trade setups. Our strategy is based on the following steps. Identify the trend, wait for a confirmation signal, check the higher time frame, and if everything aligns, pull the trigger. Let me break it down for you. In this example, the market is trending upwards. We've drawn our trend line below the price action. Now we wait for the price to approach the trend line. As expected, the market touched the trend line, broke below it, and then closed above it, forming an engulfing candlestick pattern. What happened here is that the market triggered the stop-loss orders of retail traders who wanted to join the uptrend and then closed strongly above the trend line, trapping traders who thought it was a breakout. This is called a liquidity sweep, indicating that the retracement move is over and the impulsive move is likely to begin. Since we're trading on the 5-minute chart, it's essential to confirm the trend by zooming out to the hourly chart. On the hourly chart, we see that the market is ranging. Here, the market performed a liquidity sweep at this support level, which represents sell-side liquidity. This suggests that, on the higher time frame, buyers are likely to push the market upward, at least to this resistance level. Now, let's return to the 5-minute chart. Here's how to execute the trade. Place your entry at the close of the engulfing bar. Set your stop loss just below the engulfing bar pattern. Target the next significant resistance level, ensuring a 2-to-1 reward to risk ratio or better. Let's look at another example. In this chart, the market is clearly trending downwards, making lower highs and lower lows. We draw our trend line above the price action to connect the swing highs. Remember, the goal is to get as many touches on the trend line as possible while keeping it clean. Now we wait for the price to approach the trend line. As expected, the market moves up and touches the trend line, only to get rejected. This rejection forms a strong pin bar, confirming that sellers are stepping back in and the downtrend is likely to continue. Since we're trading on the 5-minute chart, we zoom out to the hourly chart to confirm the setup. On the hourly chart, the market was trending upward and formed a double top, which is a reversal pattern. The market is also ranging, and as you can see, there was a clear liquidity sweep at the resistance level. This indicates that the market is likely to move downward to reach at least this support level. This analysis confirms that we can still take a sell trade on the 5-minute chart. Now let's return to the 5 minutes chart. Here's how we trade this setup. Place your sell order at the close of the pin bar that rejected the trend line. Set your stop loss just above the wick of the rejection candle. Aim for the next significant support level, ensuring a 2-to-1 reward to risk ratio or better. Let's move on to the second pattern, the breakout pattern. This occurs when the price breaks through a trend line, potentially signaling a change in the direction of the trend. However, it's important to note that a breakout alone doesn't guarantee a trend reversal. To avoid falling for false breakouts, you need additional confirmation. One way to do this is by identifying signs of momentum loss before the breakout. Let's take a look at an example. In this chart, the market is trending upwards, so we draw a trend line below the price action. Initially, the price is making higher highs, but as we examine the recent movement, it begins forming lower highs instead. This indicates that buyers are losing control and momentum is weakening. Shortly after, the price breaks below the trend line, signaling a trend reversal. This presents a solid opportunity to take a sell position. Now consider a market in a downtrend, where the trend line is placed above the price action. At first, the market forms lower lows, but then it starts to make higher lows, a sign that sellers are losing their grip. Eventually, the price breaks above the trend line, confirming the reversal and signaling a new uptrend. This provides a great opportunity to take a buy position. Another way to validate a trendline breakout is by spotting double rejection patterns in the price action before the breakout occurs. In this case, the market is trending upwards and forming higher highs. But then it fails to make a new high and instead creates a double top pattern, showing strong rejection at a resistance level. This rejection indicates momentum loss, and when the price breaks below the trend line, it confirms the reversal. This presents a strong case for a sell position. Here, the market is in a downtrend, forming lower lows. Suddenly, the price fails to make a new low and forms a double bottom pattern, showing support at the same level. This double rejection is a clear sign of strength building in the market, and when the price breaks above the trend line, it signals a reversal. This creates a high probability setup for a buy position. As you can see here on this 5-minute gold chart, the market has been trending upwards, and we've identified a well-defined trend line. What happens next is critical. The market breaks below the trend line. Now, if you look above, you'll notice a double top pattern and a clear liquidity sweep. Here, the market broke above this level, only to close back below it. This move was designed to grab liquidity, trigger stop losses, and then reverse direction. The breakout of the trend line confirms the trend reversal. Let's zoom out to the hourly time frame to ensure the higher time frame aligns with the 5-minute chart. On the hourly chart, we see that the trend line has also been broken, and another liquidity sweep occurred at the double top prior to the breakout. Now, let me show you something even more significant. As you can see, this is a clear order block. Once it was broken, it turned into a breaker block. When the price approached this breaker block, it was rejected. Notice how the rejection candle engulfed all the previous candles, which is a strong signal that the market is likely to move downward. With the hourly time frame confirming a bearish outlook, we return to the 5-minute chart. Now that we know the higher time frame aligns with our trading time frame, we can proceed with the trade setup. Place your entry at the close of the bearish candle that confirmed the rejection. Set your stop loss just above the wick of the rejection candle. Aim for the next support level, ensuring a 2-to-1 reward to risk ratio. By aligning both time frames and incorporating key market signals like liquidity sweeps, breaker blocks, and engulfing candles, this trade setup becomes a high probability opportunity. Stick to the process and let the market do the rest. Now that you understand the strategy, let's talk about a crucial step that takes it to the next level: top-down analysis. This approach is essential because it ensures that your trades align with the broader market context, increasing your chances of success. Whether you're scalping, day trading, or swing trading, here's how it works. If you're trading on the 5-minute or 15-minute time frame, your higher time frame is the hourly chart. You'll use the hourly to spot the overall trend and key levels, and then refine your entries on the lower time frame. If you're a day trader working on the hourly time frame, your higher time frame is the daily chart. The daily chart will help you identify the bigger trend and key zones that the market respects. For swing traders trading the 4-hour time frame, your reference is the weekly chart. The weekly gives you the broader perspective needed to hold positions with confidence over several days. And if you're someone with limited time, trading the daily time frame, your higher time frame is the monthly chart. This lets you focus on long-term trends and make informed decisions without constantly monitoring the market. That's it for today's video on gold trading strategies. I hope you found these strategies helpful and are ready to apply them in your trading. Don't forget to like, subscribe, and hit the notification bell so you never miss future trading tips and strategies. Thanks for watching, and I'll see you in the next video.